promote our company, and thank God, with God's help, plenty of the participants on here can probably vouch for our company, our services. And if you do, put down in the chat box. I'd love to know who's out there that actually knows us firsthand. I am actually going to be talking a little bit different than what I'm used to talking about today. So I will preface with that we're going to talk a little bit more about the other things besides cost segregation that have to do with the recent changes in the tax reform. However, just a short plug that I will be giving a free webinar next week on Tuesday. You can look at my profile in the forum. I put a link there if anyone is interested in learning the basics of cost segregation from firsthand. And I did one last week as well. Some of the participants participated and we had about 50 people out there. It was pretty great. So check that out and we will get right into it over here. We're going to understand a little bit about the tax reform. Some things, first of all, we're going to talk about how this is the biggest tax reform in 30 years. We're going to talk about what bonus depreciation is, because that's really, from a real estate perspective, probably the number one thing that's the buzz that people are talking about. Okay, so what is that exactly? We're a little bit about the business interest limitations, the qualified business interest deductions, 1031 property exchanges. It no longer applies to personal property. A little bit more about bonus depreciation, because as you know, that's what I like to talk about and it's kind of my expertise. And then the section 179, which is very much related to it's similar to bonus depreciation, so we'll get into how that relates. I do want to just make a note that there are many things discussed with CPA, and I didn't even have time to get everything. And truth be told, I had a big crash on my computer and lost a big portion of this presentation. And so last minute I was scrambling to kind of put stuff in that I remembered, and I didn't even remember to format the the font on this one over here. And you'll see some of the other pages I might go through a little fast. Some are even blank, and I'm just going to talk about them. And you know what? The people who had the panels earlier today, they didn't have the advantage of having the PowerPoint like we do to share some of the ideas. However, they also had the advantage of not having to prepare the PowerPoint. So let's get right into it. A quick disclaimer. I'm not here to offer you tax advice, okay? I'm not a CPA. I'm actually not an attorney, and I work with them hand in hand, and some credit goes to some of the people on our team and some other accountants that I have a close relationship with that I have spoken about with a number of these topics. So just a quick, we have a 1031 team. In fact, the head of our 1031 exchange department is one of the one of the experts in the country. Has actually written the questions or participated in written the questions on the tests for the 1031 exchanges. So I have a little bit of insight into some of the things regarding that. Okay, so a little bit of an overview. So yeah, this is the biggest tax reform and obviously has a lot of hype, okay? The biggest tax reform, a lot of hype, but at the same time, 30 years ago, I don't know about you, but I was a little kid when the previous one, Ronald Reagan, put out the previous tax reform. It is very similar in many regards, but the Tax Cuts and Jobs Act affects really small businesses more than anything else and affects real estate. Nevertheless, we are still waiting on a tremendous amount of regulations, and they're coming out little by little. And a lot of accountants that I've spoken with tend to think that they may not even come out at all. They may just live it, let's see what everyone's going to do. And then at that point, either they will come out with regulations after the fact, or they may not. So in a lot of senses, we have, you and your accountants are in pretty good hands to kind of, safely, obviously cautiously do what, he advised you to do. However, there is a lot of wiggle room, at least this year, to go ahead. So let's just jump right out. Let's get going. What is bonus depreciation? So a little bit of a history, because I think there is some confusion. Bonus depreciation. So even before we talk about bonus depreciation, I have to give a little bit of a background about cost segregation because it goes hand in hand. I'm not going to talk too deeply about it, but for all intents and purposes, depreciation is a tax deduction. Everyone who owns real estate as an investor gets this deduction on their tax return. It's required by law. Obviously, If you're not taking that deduction, you do want to talk to your CPA. If you don't have one, check that out right away. However, it doesn't apply to your personal residence. Okay, so we're talking about any business property or investment property. You get a deduction called depreciation, which, broad overview just for everyone, for the sake of everyone, I'm sure many of you know about this, but just a broad overview for those who don't. It is and if you own real estate, you probably do. It is based on the purchase price of the property. Doesn't have to do with the actual value of the property. It has much to do with the purchase price. Even if you bought a building that was built in 1922, if you bought it for $1 million, your depreciation basis starts at $1 million. You detract a little bit for land, subtract some for land. Land does not depreciate, and you're left over with what's called your depreciable basis. Okay, so let's say it's 10, 15% for land. Your $1 million property has $850,000 basis. For all intents and purposes, we're talking about multifamily on this summit. So multifamily depreciates over 27.5 years. Commercial properties over 39 years, we're not going to touch on that. So for 27.5 years, you get, for the next 27.5 years from the day you purchased it, you get a itemized deduction on your tax return, which is a fraction of the basis. So your $850,000 property, divide that by 27.5 years, every year you get about, do the math, about $30,000, give or take. Okay, that's what's called your depreciation deduction. Cost segregation allows you to have an engineer analyze the building and all the assets inside of it, divide it into 5-year property, which is called personal property. That includes appliances, fixtures, furnishings, carpeting, shelving, so many things, you name it. And on the other hand, you have 15-year property, which includes land improvements, that's like landscaping, pavement, curbing, signage, anything outside the building that's not, that depreciates over 15 years. Okay, that's what a cost segregation study will do. Take those assets, apply a cost to them, that's cost segregation, breaking out the assets, applying a cost to it, preparing a report, an engineering-based report that corroborates all of the evidence that the engineer found, and then you can accelerate that depreciation to the 5-year category, 15-year category, which means, let's say, give a round number, 20% of your $850,000 building can be moved into the 5-year category. That means you can depreciate that amount, about $170,000, over 5 years instead of waiting up the whole 27 years to depreciate that. Okay, are we clear? Any questions? I'm not going to take questions until the end, but if you do have a question, put it in the box. If you have a chat, there's a chat box as well, which I somehow can't access. Oh, there we go. Let's see if anyone put anything in the chat box. Not yet. Okay, that's cost segregation. Bonus depreciation, what it used to be, okay, before we get into what it is today, what it used to be was a extra deduction, a write-off for people who were buying new equipment, buying new property, or constructing or developing new property. Okay, something that was placed in service for the first time ever. That's what it used to be. It used to be, before the Tax Cuts and Jobs Act, someone who's developing a property was allowed to take a 50% deduction, okay, not 100%, 50% deduction of the cost of what they spent on that new item or that new development that falls into that 5-year or 15-year category, meaning anything less than a 20-year useful life. So anything that falls in the 5-year, 15-year can actually be depreciated over that faster life. With bonus depreciation, you were allowed to take that as a 50% write-off of that cost in year number 1. What the Tax Cuts and Jobs Act did was it did 2 things. It, number 1, applied the bonus depreciation. It moved it from 50% to 100% and left the 50% as an option. So you still have the 100% or you have the 50%. The second thing it did was this no longer applies to newly developments, no longer applies to something that was placed in service for the first time ever, which is what it used to be. Now, something that's placed in service for the first time by you, which means that if you buy a property, okay, that was already in life, already useful, meaning was built 10 years ago, 20 years ago, 100 years ago, doesn't matter, but you buy it, that becomes something placed in service by you today for that first time, okay? There are and this is really the biggest game changer, because what that allows you to do is take all of the amount that you would have accelerated over 5 years or 15 years, 7 years. There's some other small categories as well, but just for time's sake, anything less than 20 years, you're allowed to take that in year number 1. What this does, it creates huge additional write-offs to be applied to offset your taxable income, okay? Now, that taxable income, right, if you have extra deductions, right, what happens if you have too much bonus depreciation? Meaning, why would I want to take 100%? Why would I want to take, let's say, if I'm only making $100,000, why would I want to take that whole $170,000? Now, the answer to that is you probably don't. There's probably a reason not to do bonus depreciation. The option is there, and it can really be used for people who have a high income and want to offset that by using this extra deductions. Now, when you do the bonus depreciation, you're essentially taking all those 5-year assets, 15-year assets that you reallocated through the cost segregation, and you are taking that write-off in year number 1, but you're losing out those deductions carried forward from year number 2 and onwards, the time that you own the property. So let's say that you have this, extra deductions. You would have had $30,000 deduction every single year with straight line depreciation. Now you did bonus depreciation. You got a huge big chunk. Okay. Now in year number 2 through 27, you're only going to have about, let's say, $22,000. If you do the math, that's what it comes out to be, about $22,000 deductions. You still have depreciation on the 27-year assets. That's the main structure of the building, which a majority of the cost belongs to that. But you are left out, you're losing out those depreciation deductions in later years. Now, if someone is buying properties, and I hope most of you are planning on buying more than one property for the rest of your life, if you're going to buy more than one property next year, the year after that, this can be an incredible strategy to take your income and income tax liability and bring it down virtually to zero, okay? And what I mean virtually to zero means that you can use bonus depreciation on property you buy today. Next year, you buy another property, you can do bonus depreciation again on that one, bring your income tax. So what you're missing out in the full depreciation, you can, kind of balance out with the other thing. What I'm seeing a lot of people doing is taking the 50% bonus depreciation, because that allows you to take 50% of those assets that are less than 20 years, take that deduction in year number 1, and then the 5-year assets and the 15-year assets, 50% of that is still left over to be spread out and balanced out over the 5 and 15 years, okay? So that's an important thing to note. If you do the 50%, it doesn't mean 50% now and then everything else is left over to the 27.5. No, the other 50% of that gets spread out over the 5-year, 15-year, 27.5-year schedule. Okay, in a nutshell, that is bonus depreciation. We're going to come back to it because I want to show you some numbers. I want to show you a little bit of how it actually works when we take out those numbers. And there are actually some other things that will come back when we discuss the 1031 exchanges, and when we discuss the Section 179 deduction. We'll see how that relates to bonus depreciation. So again, this is going to come back. If you do have questions, please make sure to ask them so we can get to them at the end of the session. Okay, so yeah, this is just an example I gave. This is from a multifamily property. You can take a look over here. These are some of the things that would fit into those 5-year or 15-year asset classes that would be reallocated through cost segregation, okay? It's not a comprehensive list, but these are some of the things that are usually found in a garden style apartment complex community. So, just take a look over here. You have, if some of those of you who don't see the screen, stuff like I mentioned before, special purpose electric, special purpose plumbing would go into the 5-year category, carpeting, equipment, furniture, etc. So many different things. And then the 15-year category, again, stuff that's outside the building, land improvement, that would have to, even if it's pavement, any type of pavement, the driveway, parking lots, landscaping, fencing, you name it, even a playground or swimming pool, these things all depreciate over 15 years. Make sure you're taking advantage of those assets. Okay, moving right along. And I think, like I said, this was a much more comprehensive PowerPoint, but I ran out of time. So so all you got is this slide with a pretty picture, okay? And I wasn't able to put this stuff. Okay, what is the business interest limitations? Moving right along. I know we have a lot of time, but I do want to touch on most of these points. Business interest limitations, okay, this is something that changed. And I didn't include all the notes over here, but I'm just going to speak about them a little bit. What this means is that if you have a business that produces income, number one, over $25 million a year, which I assume most of you don't, and most people who are starting out in real estate don't. So it probably won't apply to you. Where it may apply to you, and this still needs some, there's still some regulations coming out on this to understand, but if you opt to be what's called a real estate business, okay, and many of us are, especially if that is our main business. So you may be restricted to these business interest limitations. What that means is that if you have interest, and I assume most of us who are buying property is buying it with financing, okay, used to be the interest of the financing, the interest that you paid was a complete deduction. You could deduct that on your tax returns. Now you are limited. If you're a real estate business, you're limited to those deductions to a 30% of that is limited. That means that you're not allowed to take the entire amount that you would have taken in previous years. However, it can be carried forward, meaning if you missed those deductions this year, you can carry forward it to the next year. It's still going to affect us very drastically, meaning only 30% to 70% of that interest amount is allowed to be deducted. Okay, the other thing that what happens when you do this is, the other category that this would apply to would be someone who is what's called a tax shelter. Now, there is some discussion about this. I know I had a discussion with Brandon Hall about this recently, and there are many different views on this. So I'm not going to say what the correct answer is. However, I will say that there are those who are of the opinion that a tax shelter is also defined by this business interest limitations, which means that if you are what's called a tax shelter, we back up a little bit. Some want to say that a syndication is defined as a tax shelter. And I know a lot of people involved in real estate are doing what's called syndication. A tax shelter is defined as if there's a limited partnership of 35% or more of the stake in the ownership is defined as a tax shelter. Now, again, there are opinions if this is the way to view that. If there's not, I'm not saying what is right, what is wrong. I'm just saying this is one view. Make sure you discuss this with your accountant to see. So that tax shelter is now going to be, have to be subject to these business interest limitations. Now, if you opt out of the business interest limitations, what if you say there is actually an option that says, I do not want to take this. I would rather use all of my interest as a deduction, right? But if you do that, there are two options. You could either be subject to this, but if you're not subject to it, you opt out of it, there's something else that is going to be forcefully applied to you, which is called the alternative depreciation system, okay, ADS, which means that you no longer look at the building as broken down into, like we mentioned before, 27.5-year, 15-year, and 5-year categories, and also the bonus depreciation. The ADS, or the business interest limitation, the alternative depreciation system, says that you have to go on a different scaled system, which moves the 27.5-year to 30 years, moves the 15-year property to 20 years, and the 5-year property to 9 years. You could still do cost segregation and get those benefits, albeit less upfront, and you may not be able to take the bonus depreciation in year number 1. So there are some, either if you're making over $25 million a year, or you are looked at as this tax shelter, which may or may not apply to syndications, or at least the active participants in the syndications. The limited participants, limited partners would not be subject to this anyways, but the active participants would be potentially. Nevertheless, there are those who also disagree with this standpoint. And again, that's the beauty of the tax reform. Congress can come out with all these rules, and then every accountant and everyone in the world is scrambling to try to figure out what does this all mean. Meanwhile, Congress is sitting back trying to make regulations, after the fact that they put these rules out. And the truth of the matter is there are varying viewpoints from many across the spectrum of what it means. So as long as you are comfortable with what your accountant, is doing with you, and I assume you are, because accountant CPA is probably one of the most trusted advisors that we have. So go along with them, make sure that they are clear and they have a clear stance, whatever that stance may be on this area, because it may apply to you. That being said, there is an alternative way of looking at this, which is that the ADS, the alternative depreciation system, actually does not apply to the taxpayer or the entity, the LLC per se, rather it applies to the building. Now, the building itself, and there is a lot of literature written up on this, that the alternative depreciation system, the ADS, applies to the building and therefore only the 27.5 year, meaning the main structure of the building. But the personal property, which is a different category entirely, does not have to follow those rules of the ADS. It's a little interesting, but that's actually what this literature says. And there's many sources in the code to support this. Therefore, you are allowed to do bonus depreciation. You are allowed to accelerate that depreciation on the 5-year, 15-year property because only the building itself, the main structure, the 27, is going to take that ADS. Okay, so there are many different ways to do this. I'm not going to go too much more into this because it is complicated. I don't want to bore everyone right out of your minds, especially since I don't have a clear, thorough write-up about this. But let's just pretend it's a panel and I'm just talking. So I hope you're paying attention, and it is recorded afterwards. So if I miss anything, you can always go back. The next subject we will discuss today is what's called the QBI, the Qualified Business Interest Deduction. This is probably one of the biggest things. Whether this applies to you or not, again, this is going to be a big discussion with your accountant. Whether this applies to real estate or not, on the next slide, we're gonna get into that. So the first thing you need to know about the QBI, the Qualified Business Interest Deduction, and this is a big thing. This is for